Hi guys. Today we will analyze Fox Corporation stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Fox has been an average performer in the overall market. Also recent evolutions are not positive. The long-term trend is neutral, but the short-term trend is negative. Support levels are around $34.80 and $33.20. Next support level is around $32.20. Resistance levels are around $36.90 and $39.50. Next resistance level is around $40.20. In the last month the stock has been trading between $34.80 and $38.60 range. It is currently trading near the lows of this range. The stock has an average volume of 4 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 8% per year, for last 4 years. We see that the average profit margin of the stock has been around 13% per year, for last 4 years. Also we see that the average free cash flow to net income rate of the stock has been around 108% per year, for last 4 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Fox Corporation: bad, average, and good. First scenario. Fox Corporation will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 11%. Future free cash flow to net income rate would be a low, 75%. In this case, the fair value of the stock today would be $50. Second scenario. Fox Corporation will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 12.5%. Future free cash flow to net income rate would be average, 87%. In this case, the fair value of the stock today would be $68. Third scenario. Fox Corporation will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 14%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $90. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.47. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Fox Corporation, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 13. Again, I will use 3 different scenarios for Fox Corporation: bad, average, and good. First scenario. Fox Corporation will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future P/E would be a low, 11. In this case, the fair value of the stock today would be $16. Second scenario. Fox Corporation will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 13. In this case, the fair value of the stock today would be $21. Third scenario. Fox Corporation will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 15. In this case, the fair value of the stock today would be $27. As you can see, today the stock is overvalued, $38, even if we expect the company's high performance in future. The fundamentals are good, but the stock is expected to show a very small growth in the next 5 years, 4 to 6% per year. Do your due diligence on this stock. You may like it at these levels, but I personally will wait until it drops below $30. It's just an opportunity cost. There are many other good stocks with better growth. Keep in mind that there are 2 Fox stocks. Fox Class A, ticker FOXA. It traded at $38 yesterday. It gives you more voting rights, and a yearly dividend yield of 1.23%. Fox Class B, ticker FOX. It traded at $35 yesterday. It gives you fewer voting rights, but a higher yearly dividend yield of 1.34%. It's up to you, which one to buy. It doesn't really matter. Class B is usually $3 cheaper than Class A. Company strengths. Fox owns one of 4 major national broadcast networks, that are the only television outlets capable of reaching almost all 120 million households in the U.S. Fox News remains the king of the cable news hill, and the firm can leverage its strong ratings and audience loyalty to grow affiliate fees. Between Fox News, Fox Sports, and the Fox Network, Fox can offer content that appeals to almost any viewer, making the firm's channel bundle must-have content for most pay television distributors. Investment in sports betting has reignited Fox's future earnings potential, signaling that they are prepared to diversify their interests to streamline revenue. Fox is financially healthy and has no problem in meeting its short-term obligations. Fox's return on assets of 6% is amongst the best of the industry. Fox has a return on equity of 12.7%. This is comparable to the industry average. Fox has a profit margin of 10%. This is better than the industry average of 5%. Risks. Recently, Fox has had some issues regarding its customer base, as a sharp decline in news media viewership negatively impacted the company. The changing media climate favoring streaming has hurt Fox's platforms, but they have mitigated this by maintaining a healthy cash flow while minimizing payouts. Critics of Fox News and of specific hosts have led multiple boycotts of advertisers. Some of these boycotts have been very successful in causing larger corporations to cancel their advertising on the channel, and specific shows. Fox does not have a studio, the only one of the 4 major broadcasters without an affiliated studio. The firm will be squeezed by outside studios that will pass through increased production costs. While Fox did renew its NFL rights until 2033, the firm overpaid and margins will compress in 2023 and beyond. The revenue is expected to grow by only 4 to 6% on average over the next 5 years. The earnings per share is expected to grow by only 7% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.